Folks, this is a third of a four-part video series, and what I'm teaching you today is very simple. I'm teaching you the best sectors to trade during a bullish market cycle, a neutral market cycle, and a bearish market cycle. In the first video, I explained how to use a very simple tool, the 50-day moving average, to gauge the overall market behavior. In the second video, I explained the two sectors that we trade during a bullish market cycle, and now I want to talk about what happens if the index, if the S&P 500 is trading at the 50-day moving average. In other words, here's the bars and the index is and the moving average is right here. In other words, price is not above, price is not below, price is right in the middle. All right? So if price falls in between the moving average, it tells us very clearly markets are stagnant. They're moving sideways. When markets are stagnant, you don't want to go into speculative sectors, because when markets are sideways or choppy, when they lose that directional bias, what happens is traders begin moving out of speculative stocks and they start moving into stocks that are a bit more defensive. And the three primary sectors that traders move into are consumer staples. Don't confuse consumer staples with consumer discretionary. Consumer discretionary is buying luxury goods, things that you don't need to survive. Whereas consumer staples are things like toothpaste, orange juice, things that are required, needs versus wants, okay? Just a very simple explanation. Material, basic materials, they start rising because, again, stocks are becoming defensive. Investors want to put their money into stocks that have dividends. They're not thinking speculative upside, they're thinking survival mode, okay? So material, basic material, and lastly, industrial. When stocks become sideways, when they become sideways, a little choppy, industrial stocks begin to move because people start thinking that stock market, investors start thinking that the stock market may not be the best investment, and they start looking at real estate or other modes of investments, and that's where industrial stocks begin to rise. Building, construction, land development, other means of money, flight to quality it's called, when stocks are moving slightly lower and people rotate money out of speculative stocks and start buying fixed income or other defensive assets, okay? So again, when stocks are bullish, when the S&P 500 is trading above the moving average, when the moving average is below price, that means it's trading above the moving average, then you're trading speculative stocks like consumer discretionary and tech. But when price and the index are on the same level, when the index is here and the moving average is crossing it, when it's on the same level, that's telling us markets are stagnant, and that's a time to start transitioning into consumer staples, materials, and industrial stocks. And again, if you guys like these videos, please like them, or please reach out to me at roger@wealthpress.com and give me a shout out. I'd love to hear from you. And in the next video, I'll talk about what happens, what sector to trade when markets are bearish, when the S&P is trading below the 50-day moving average. And that's coming up next.